Welcome to Muffet Investment Views, where we delve into the intricacies of the financial market to bring you insightful analysis and informed investment strategies. Today, we're focusing on a titan in the energy sector, EXXON Mobil. As the largest integrated oil and gas company in the world, EXXON Mobil stands at the forefront of the energy industry, steering the global economy in profound ways. But what makes EXXON Mobil a focal point for investors and industry observers alike? Dive with us into EXXON Mobil's strategic assets, starting with their pivotal stake in Guyana. This South American country has emerged as a hotspot in the oil industry, and Exxon's significant presence there is reshaping its portfolio with promising prospects for substantial returns. Adding to its repertoire, ExxonMobil's recent acquisition of Pioneer Natural Resources underscores its strategic expansion and reinforces its position as the top player in the competitive energy market. This move not only bolsters Exxon's resource base, but also enhances its operational capabilities, signaling a strong forward momentum. But ExxonMobil isn't just about oil and gas. The company is making significant strides in green energy technology, investing in carbon capture initiatives and lithium mining, key components in the transition to sustainable energy. These ventures reflect Exxon's commitment to innovation and adaptation in a rapidly evolving energy landscape. Join us as we dissect ExxonMobil's financial health, operational strategies, and future prospects. Whether you're an investor, a market enthusiast, or simply curious about the energy sector's dynamics, this analysis will provide you with a comprehensive understanding of where ExxonMobil stands today and where it's headed tomorrow. ExxonMobil financial metrics. Market cap, $482 billion. Current stock price, $121. Price-earnings ratio, 13. Dividend yield, 3.8%. Net income, $36 billion. Return on equity, 18%. Total debt to equity, 5%. ExxonMobil is vertically integrated oil and gas company with upstream, midstream, downstream, chemical products, and clean energy segments. They also are big in LNG with joint venture projects with Qatar, which is one of the biggest LNG exporter, and also operating in Papua New Guinea. We have identified from our research on ExxonMobil that it is the top oil stock, but due to their footprint in all aspects of energy, it would be difficult to present all aspects of their portfolio in a single video. Today at Muffet Investments, we only focus on things that make Exxon stand apart from its competitors like Chevron. So on this video, we will focus on Exxon's Permian acreage, their Guyana stake, their acquisition of Pioneer Natural Resources, their LNG projects, and renewable energy projects. If we compare the charts of Exxon with their closest competitor in US, which is Chevron, we can see both of them move lockstep to each other, till they bought Pioneer Natural Resources. And when Chevron tried to catch up with them by acquiring Hess, Exxon has filed complaint with the arbitrator to have first go at Hess stake in Guyana. With the uncertainty of the Hess acquisition by Chevron, we can see that Exxon has started to outperform Chevron by quite a bit, and if they do manage to get hold of Hess's 30% stake in Guyana, it will be a game changer for Exxon. It remains to be seen what will happen, but even without the Hess's stake in Guyana, Exxon is still a great oil stock and should benefit from green energy projects which will increase cash flow from 2030 onwards. Here we outline Exxon's strategic advantages and also look at the energy market dynamic and also look at options opportunities. Pioneer Natural Resources acquisition. Exxon acquired Pioneer Natural Resources for $60 billion in November 2023. Pioneer was producing about 470,000 barrels of oil equivalent per day. They had the best acreage in the Midland Basin of the Permian, and together with Exxon's acreage in the Permian will make Exxon the largest acreage holder in the Permian, which is the second largest oil field in the world. Exxon CEO Darren Wood believes that the technology developed by Exxon would be better able to increase the oil production in the Pioneer acreage. It also provides the natural gas that will be used as the feedstock for Exxon's large hydrogen production complex in Baytown, Texas. Exxon paid 15 times Pioneer's 2023 cash flow for the acquisition, and because it provides the synergies, it is a great deal for Exxon. Even the Pioneer Resources chairman, who owns a significant stake in Pioneer, believes that Pioneer would be better off with Exxon and plans to retain a significant portion of the Exxon stock that will be assigned to him if the deal goes through. Guyana, Stabroek Block. This is the one that sets Exxon apart from other oil majors. Chevron acquired Hess hoping to get exposure to this prolific field. But there may be problems with this, as Exxon is disputing this takeover, as they have first refusal to buy the Hess stake in the Stabroek Block. If Exxon wins in this arbitration case, it will be a huge boost for Exxon and propel its share price even higher. Now let's take a look at the Stabroek Block. Exxon started exploring in Guyana in 2008 and announced their first discovery in 2015. Since then, more than 15 discoveries has been made. The recoverable oil has been estimated to be 11 billion barrels of oil and 32 trillion cubic feet of natural gas. The fact that Exxon is disputing the Chevron takeover suggests that they believe that there is more oil to be found than is currently estimated. The current production will be ramped to 750,000 barrels of oil by 2025. If you look at the Hess investor presentation, the Guyana oil is recovered at a cost of $25 to $35 barrels against the current Brent price of $90. The best part is after 2027, the cost will drop to $10 per barrel, which will propel cash flows even for an oil major like Exxon. So at Muffet Investments, we believe that this sets Exxon apart from all oil majors and should be the stock to be in. For disclosure, we own Chevron, but we'll be looking to acquire Exxon if a good opportunity arises. Exxon is a green energy company. With more than 30 years of experience in carbon capture, Exxon leads the industry in the successful deployment of this technology at scale. They are continuing to develop and expand their capacity for storing CO2 on a long-term basis. On the U.S. Gulf Coast, they are building carbon capture and storage infrastructure that will allow industrial customers to work with them to significantly reduce their emissions. We expect the first of our Gulf Coast projects to be operational as soon as 2026. The only downside is that currently these are expensive and require subsidies from the government to be profitable, but EXXON Mobil chairman believe that they are continually improving the technology, and as they expand, it will produce economies of scale and will become competitive. Each 5 million tons of carbon dioxide sequestered is equivalent to putting 2 million EV cars on the road. Because carbon capture and storage projects require geologic space, they continue to add suitable acreage both onshore and offshore for this use. This is one of the main reasons that they acquired Denbury Resources for $4.9 billion. ExxonMobil now has the largest owned and operated CO2 pipeline network in the U.S., adding more than 1,300 miles. The company also has access to more than 15 strategically located onshore CO2 storage sites. Exxon already has contracts with CF Industries, Nucor Steel, and Linde to sequester their CO2. If government subsidies are extended, deals to sequester CO2 from more companies can be made and make the clean energy business a cash flow machine for Exxon from 2030 onwards. Blue hydrogen. ExxonMobil is planning its first world-scale plant for the production of low-carbon hydrogen at our refining and petrochemical facility at Baytown, Texas. There, they expect to produce up to 1 billion cubic feet per day of hydrogen made from natural gas, and expect over 98% of the associated CO2 to be captured and safely stored underground. As a result, the site would be the largest low-carbon hydrogen project in the world at planned startup in 2027 to 2028. This project would be a game-changer in two ways. First, using hydrogen to fuel their olefins plant at Baytown could reduce site-wide CO2 emissions by up to 30% compared to current operations. The project would support EXXON Mobil's ambition to achieve net zero greenhouse gas emissions across operated assets by 2050. Second, the carbon capture and storage project included in this plan would be one of the world's largest, capable of storing up to 10 million metric tons of CO2 per year, equal to the emissions from more than 2 million cars. ExxonMobil has an extensive global position in liquefied natural gas. One such project, PNG LNG in Papua New Guinea, recently reached production equivalent of 8.3 million tons per year. They partnered with Qatar Petroleum to develop the North Field, the world's largest non-associated natural gas field. Through the Qatargas-operated joint ventures, they have participated in 12 of the 14 LNG trains, 27 of the world's largest LNG ships, and Qatar's largest condensate refinery. Further down the LNG value chain, ExxonMobil has partnered with Qatar Petroleum in 2 LNG receiving terminals in Europe. This move has become strategic as now Europe is importing more LNG from Qatar rather than Russian gas. They are also involved in LNG projects in Australia, and this is vitally important to supply LNG to growing Asian economies, especially India. Exxon also have plans to mine lithium using a unique technique which is less disruptive to the environment compared to conventional lithium mining. They plan to pump lithium brine deep under the oil fields in Arkansas and process the brine to extract the lithium and then pump the brine back. They plan to start this in 2027, and by 2030 they intend to produce enough lithium to make 1 million EV. Oil market outlook. The total demand for crude oil has increased steadily over the years, but more slowly recently. This is in spite of the electric cars and the green energy revolution taking place. This is due to increased demand from Asia and Africa from their rising population and increased standards of living. This has more than compensated for the reduced demand from the Western countries and will continue to do so for a few more years. Moreover, crude oil producers want to keep oil prices high so they can sell the oil at a higher price. This is why OPEC has reduced the supply of oil, even though American production is at record high. But the American producers like Exxon will also benefit from the high oil prices and manage to pay down their debt and acquire other producers to become larger. Looking at the crude oil chart, the next objective is $94. This is not a forecast, but an expectation. Exxon is currently trading at $123. It is not a good idea to buy a stock after a 25% move or when the commodity that they sell is at a higher price. The Muffet View. ExxonMobil is one of the best oil stock for exposure to oil and inflation. We look for correction to add to portfolio. Options. The January 2026 $110 puts our $8.50, and the January 2026 $105 puts our $6.85. You can sell any one of the puts and collect the premium. We hope you liked this video, and please like, share, and subscribe.